You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by our special guest today, Paul Ahdal. Well, firstly, Paul, thank you for coming on the show. Would you be able to just talk us through how you became interested in investing and just briefly talk us through your investing career to date?
Hi, Sam. Yep, no problem. Good to be on. I've been enjoying the regular weekly podcasts and interviews as well. So good to be able to contribute. In terms of kind of my investing career, I've come to investing quite late, really. I'm kind of unfortunately, hitting my late 30s at the minute. And I only started investing in 2019. So just been doing this for about 3 years. Nobody in my family kind of invested. I didn't really know anything about it. And I just assumed investing was a bit like, it was either like something like out of a scene in Billions where you've got, traders and quants looking at charts constantly or the old stereotype of people being on the trading floor. Kind of when I left uni, I was more focused on things like, paying off student loans, learning to drive and get a car, getting onto the property ladder, that kind of thing. But I reached a point where I'd started to put together some savings and overpay my mortgage, paid off my student loan. And you kind of look at the options at that point and you get in kind of next to nothing on your savings account and you think there must be a better way to put my money to work. At the same time, there was a guy I used to play 11-a-side football with, and he's one of those like people who's he's been very successful with his own business. Kind of, you look at it and think he's putting the rest of us to shame a bit. But he just randomly recommended on Facebook a book called Rich Dad Poor Dad by Robert Kiyosaki, and he just said it changed his life. He read it before he set up his business and it changed his life. So I thought I'll give it a read, and it just made kind of perfect sense to me, really, that you need to have your money working for you, not the other way around, and that's the way to become financially independent. And I kind of read that and thought, well, getting into property like Kiyosaki did is it's hard unless you've got a lot of money for deposits, and particularly with how things have changed in terms of how tax efficient owning extra property is. So I decided to go down the investment route. Kind of started initially with just some Vanguard funds, and the more I kind of read into investing, the more I thought, I don't think an efficient markets hypothesis makes sense, because to be frank, people aren't rational and they can't predict the future. So I started to try and learn more about individual stock picking, and I've done that. And I'm at this point now where I've still got some passive, but I'm trying to pick individual stocks and hopefully kind of enjoy it, and hopefully over the long term I'll do okay.
So how long were you doing the passive for before you made the jump, and what triggered the jump from passive to active?
I think I was doing passive probably initially for about, it was probably only for about 6 or 7 months before I made the jump into active and bought my first individual share. I think what did it was probably a couple of things. So, initially I kind of, once I got bitten by the investing bug, even passive, I just wanted to learn more and more about it. I just found the whole subject fascinating, and I got drawn into kind of lessons of Benjamin Graham. So I know the concept of Mr. Market and stock prices, fluctuating and kind of trying to buy them cheap, and that made perfect sense to me. So I kind of got drawn in through those teachings, and I read a book called The Acquirer's Multiple, which is by a guy called Tobias Carlyle, who's an American guy. I think you've mentioned some of his podcasts before.
Yeah, he's very good.
He is, and kind of in that he had this kind of, it was almost like a step-by-step kind of way of how he assesses kind of deep value stocks, and I kind of got drawn in through deep value. So I started off trying to find kind of stocks that looked very cheap, but it was, I suppose the issue I had then, I was thinking, well, I'm buying stuff and I'm just buying it because it's cheap, and it didn't feel like enough for me. And I then started, as I read more about kind of Buffett, and I also kind of influenced by a couple of English investors as well. So Phil Oakley, who's very good, his book, How to Pick Quality Shares, and Lord Lee's book, How to Make a Million Slowly. I think Lord Lee's book's brilliant because it just shows how, over time, you don't have to do anything kind of risky. You can just pick good businesses at a reasonable valuation and let time do its work. I think I gradually kind of went away from the kind of purely, I've still got a value tilt, I'd say, but I'm looking now just beyond things that are just cheap.
So when you did make the jump from passive to active, how did you go about doing it? Did you sell the passive, or did you was the new funds going into active and then the passive becomes a smaller proportion of the portfolio over time?
Yeah, it's the latter. So I kept the passive because I kept the kind of thinking was keeping the passive is if I'm not very good at this, I've got the passive to fall back on. So I kept the passive, and because I tend to manage my investments through my ISA that I just fund from my monthly wage, it was just a case of any new funds going to buying, individual shares and trusts and that kind of thing.
So does any proportion of your new funds go into passive anymore?
Occasionally, I suppose I've got a SIP as well, which is pretty much all passive, and that's just a collection of old workplace pensions, and I put a small amount into that every month, so I do that. Occasionally I will use some passive, but now I'll do it if I want exposure to a particular area. So I added one passive fund recently, EMQQ, which is emerging markets e-commerce. When you had the recent pullback on the kind of due to the Chinese crackdown, I just kind of wanted a basket exposure to kind of emerging markets e-commerce stocks, because I think that'll be, the emerging markets are a growth area anyway, but I think if you look at how growth has happened in the West, which has been in a lot of those types of businesses, my kind of theory was you'll get the same in emerging markets, and it's like a growth area in a growth market. So I kind of added that as a passive fairly recently, but it's kind of almost passive with a bit of an active mindset.
So could you talk us through your investment appraisal process and how you would actually approach looking at a new stock or potential investment?
Yeah, so I think the first thing I'd do is that if I want to have a look at something, is I've got a SharePad subscription, and what I've done on SharePad is there's about 30 metrics that I look at based on things like profitability, returns on capital, cash generation, debt management. And I've now got them saved in the standard settings on my SharePad set up. So what I'll do is I'll kind of, if I like to look at the share at a high level, I'll cycle through them, and if they're looking good, I'll look at them a bit more detail, and I'll give the share a kind of red, amber, or green based on each metric. And if about 70% of them are green, then I'll look to value the share. So I tend to use a discounted cash flow and then a reverse discounted cash flow as well. And if a stock's trading at a discount to my valuation, I'll take a bit of a close look. If not, I might stick it on my watch list, and then I'll start to have a look at particularly insider ownership. So I like to see owners that have skin in the game, and preferably not just through options, through them actually buying or having a big stake. And I'll have a look at what price they're buying the stock at. If it ticks that box, I'll then go through the annual reports, particularly the accounting notes and the auditors section, and I'll also have a look through the RNSs. And while I'm doing all that, I'll just create a simple list of kind of bull points and bear points for the share. And at the end of all that, if enough of my boxes are ticked, I'll tend to take an initial position, and I think that allows me just kind of a bit more time to look a bit more deeper at things and just scale in.
How do you decide what to use as your discount rate for the discounted cash flows?
At the minute, I just use a standard rate of 10%. I know in the kind of era of pretty much zero interest rates that people are using a lot lower discount rate, but I know that Kenneth Ashworth-Lord, who runs a Buffetology fund, he uses 10% as a bit of a kind of conservative measure. For me, I think that 10% seems more reasonable if rates get back to kind of historically what their average is. And because it's a long term, I'm taking a long term view, and I think that low interest rates in the long term aren't really sustainable, and we'll start to see it creeping up. I thought 10% seems reasonable. clearly, if we had rocketing interest rates and inflation, I might have to make that higher. But kind of up until fairly recently, I think 10%'s been, if anything, you could probably say it's a bit too conservative, but I prefer to operate with a bigger margin of safety, because I recognise that, using DCF, it is just a very rough estimate.
I don't use DCFs as part of my own analysis, but I think if I were to use them, I would probably use a 10% discount rate as well. I've heard quite a few people suggest 10% as the minimum hurdle. And I do think even with the interest rates at like 0% or whatever they are, if you can't be getting 10%, you're probably better in an index, because you're probably going to do 6 to 8% in that anyway. So I think it is about right for a discount rate, to be honest.
Yeah, I mean, it's there's some good stuff on DCF out there as well. So I think the guys who do the Investors podcast on their website, they've got a fairly kind of, it's all kind of planned out for your DCF calculator. It's got a bit of a tutorial that walks people through. I think I used that when I started. So anyone who's interested in it, I think it's probably best heading over to their website and just watch. They've got like a little 15-minute tutorial that takes you through it step by step.
For your red, amber, green, is that something you came up with yourself, or did you get that from someone else?
Yeah, I just used it myself. It tends to be something kind of in my job. I do a lot of risk management, and generally when you're rating risks, you'll give it a score out of 5, and then that'll correlate to a kind of color, red, amber, or green. So I came up with myself, and essentially I kind of looked at it in that if I'm looking at a return on capital employed, say if I want it to be at least 15%, if the company I'm looking at has done that kind of 9 or 10 years out of the last 10 years, I'll give it a green. If it's kind of around the 7 or 8, I might give it an amber, and if it's less than that, I'll give it a red, or if it's consistently below it, I'll give it a red. So I'll do it that way. I mean, I'll kind of caveat it in that if I'm looking at something in a sector where, say, return on capital employed tends to be much lower, I might kind of judge it against its peers rather than simply an arbitrary figure. But yeah, it's just something I came up with myself, just because I think it kind of, when you're looking at kind of that many different metrics on SharePad, it's an easier way of trying to form an overall impression of something.
I know you've touched on a couple already, but what are the best books you've read on investing, and how much do you read in general?
I read a lot, so I tend to read about investing, either books or articles every day, pretty much every day. And my bookcase at the minute is heaving under the weight of investing books I've got to read, as is my Kindle. So I do like reading a lot, but I think The Art of Execution by Lee Freeman Shaw is one of my favorite investing books. It's really, really fascinating insight. So I don't know if you've read the book, Sam.
I've not actually heard of that one.
No, I really recommend it. He essentially went and got a group of fund managers and give them all some money to invest, and then kind of observed kind of how they invest. And it was just some really fascinating insights. So I won't give away too much of it, but one of them was he found that there was a fund manager who was right 70% of the time, but made nothing because they're always snatching at the profits to invest into something else, and the kind of something else, the new idea, actually wasn't as good as the original one. And then I found that really useful in that, it does make sense to me that if something's doing well, why would you sell out of it? Why would you sell out of it completely? So I recommend The Art of Execution. As like I say, a lot of it almost comes back to kind of having a process and psychological, but it does also show that you can have kind of many different ways of being successful in investing. I've just finished Richer, Wiser, Happier as well, that's really interesting. That's a guy who is kind of he's a finance journalist, and over the years he's spent time with a lot of the kind of famous investors like Nick Sleep, Buffett and Munger, Monish Prabhai, people like that. So it's his kind of wisdom and nuggets from spending time with them. And a few very successful investors kind of I've never heard of either. 100 Baggers by Christopher Meyer was really interesting as well. Again, I think that was just showing the danger of snatching at profits. And kind of slightly different one that you can't replicate is, have you ever read A Man for All Markets, which is Edward Thorpe's autobiography.
No, I've not heard of that one either.
No, it's a guy. I mean, the guy's an absolute genius. So for me and mortals, like there's nothing you can replicate. But he was a guy who he came up with the card counting kind of philosophy, and he kind of did that. Kind of got banned from a load of casinos. Invented a computer that could predict where the roulette ball was going to fall. But then he went into fund management and ran this like one of the first quant hedge funds, and was hugely successful. But his book's really interesting.
Did you say it's a biography or?
I think it's an autobiography. I think
Oh,
it's
right.
his book. Yeah, I think it's his book. Yeah.
That sounds very interesting, actually. I've actually got Richer, Wiser, Happier on my shelf, but I've not read it yet. 100 Baggers, I read that a couple of years ago, and I thought that was fantastic. I really enjoyed that.
No, I agree. I think 100 Baggers is worth anybody reading.
Yeah, I think it's definitely worth reading as well if you've got more of a value tilt as well, because I think it is interesting to see. I think you should look at both sides of any argument, really. So if you're going to read The Acquirer's Multiple, you should probably read 100 Baggers straight after, I'd say.
Yeah. Definitely two extremes.
Yeah. So what are the best resources that you use for investing? And these can be free or paid.
For how I invest, I mean, SharePads is essential. So you've got kind of all the fundamental data in there, and it covers kind of, UK, American, and European stocks. And I think when I first started, I was trying to do things like just show revenue growth and work out free cash flow by going through annual reports, and it was taking forever. So SharePads well worth the it's not majorly expensive. It's well worth a couple a few £100 a year. Saves me a lot of time, and they've got some good blog content on there as well. So yeah, got some interesting bloggers. Phil Oak used to write for them, and then there's all Phil Oakley's old kind of articles on there as well, which are well worth a read through. I think one of the other resources, probably a bit different, is I've joined an organisation called Signet through ShareSoc. Have you ever heard of Signet?
No, I think I've heard of ShareSoc, but not Signet.
So I joined ShareSoc, and they had this offer to join something called Signet, and I think it's called the Serious Investors Group Network. So I think I got a free trial, and I joined it. And it's essentially, I think it's not much more than £20 for the year, but it's like just a network of various investors throughout the UK, and there's like groups based on kind of investing themes, based on where you're based in the region, and you just all tend to get together like once a month and just talk about investing. So people present on how they manage a portfolio, a particular stock that they like, and it's been like invaluable to me, because I think when I started investing and I'm doing it on my own, you kind of like, is what I'm doing right? Am I on the right kind of line? And you get people who do things vastly different to you, but you get other people who do similar sorts of things, and it's great to learn about. It's almost that research piece as well on a stock. It's a bit of a shortcut, because when you've sat through someone presenting for 20 minutes on a stock they like, it's just cuts out you having to repeat a lot of that. And they do things like they have a yearly competition as well, a bit like your kind of fancy portfolio, but each group picks like 10 stocks, and they have a yearly competition. There's a monthly update and newsletter for a bit of fun. But I'd recommend it to anyone. I mean, Danny Wallace, who is a director of Signet and runs it, everything's really well organized. And yeah, I kind of give it a plug. It's not much money, but I really like it. I think Signet's brilliant.
How much is it?
I think it is, I'm sure membership's about 20 or 30 quid. Can't remember off the top of my head. No, for the year.
All right.
For the year. Like, it really is ridiculously cheap. You're kind of just paying for the admin, and that's it.
Right. Sounds a bit like Toastmasters, but just for investing.
Yeah, it's that kind of thing. I think at the minute, if people go, you can get onto it through the ShareSoc website, and I'm sure there's normally something like you get a couple of months trial or a couple of months free. But yeah, it's £25, or if you remember a ShareSoc, it's £15, and that's for the year. So it's a bargain.
Oh, I'll actually have a look at that, and if there's one near me, I'll probably start going into that. So who do you look up to as an investor?
In terms of who I look up to, Buffett and Munger, I think I think pretty much every investor likes Buffett and Munger. But yeah, I think I'd agree. I mean, I'll probably quote something from one or one or the two of them pretty much every day. Kind of in terms of other investors, I kind of look up to, I think Michael Burry's a bit of an oddball, the kind of one of the characters from The Big Short, but I kind of look up to him. So when you read his book, it shows how close he came to pretty much losing his fund when because he'd been calling the financial collapse for a long time, but his investors were getting really annoyed that he was just buying all these credit default swaps and they weren't performing very well. And I kind of admire someone who can stick to the guns and not blink for that long. I think other investors, I think Anthony Bolton, who's kind of an old UK fund manager who wrote a book called Investing Against the Tide, and his view was essentially that, if you want a different result to everyone else, you've got to do something different to what everyone else is doing. So I look up to him, and again, I know I've talked about him earlier, but I think Lord Lee, I think he was the first or one of the first reported ISA millionaires, and his kind of very, low risk, patient approach to investing, I think I really look up to.
Which Twitter accounts would you recommend following the most?
In terms of Twitter accounts, I'll probably touch on a few UK focused ones. So there's a kind of, I've got a list on our Twitter account of UK private investors, but there's a guy called Maynard Payton who he writes for, I think he used to write for the Motley Fool years ago, but he has a blog which is kind of loads of information on and interesting, and he also writes for SharePad, and he's a kind of tends to be a bit more small mid-cap focused, but his Twitter account's interesting. There's a guy called Richard Bedard as well who writes stuff for Interactive Investor and SharePads, and again he's got his own kind of scoring system that he talks about in his updates for Interactive Investor, which he uses to select stocks. So that's quite interesting. And there's a guy called Jonathan Curry. Again, he's a very experienced guy. I think, again, he used to work in the industry and now he tweets about various things, but he'd wrote a blog, I think, around about Christmas, New Year time on interesting lessons learned from his life in investing. And there's another bit of a kind of slightly different one. There's a American guy called Josh Wolf who posts some interesting stuff. Again, he's a professional, but last week he was talking about how inflation was, he didn't see it as linear. He was talking about how likes of Nike and Under Armour have got building up large kind of inventories that they can't sell and they're going to have to discount, whereas essentials like food and any of your kind of companies that provide essentials like food and energy, they've got the opposite problem. So there's a whole host of other ones. I think some of the people who've been on the Investor Way I'd look at as well, but those are perhaps a few different ones for people to look at.
What do you know now that you wish you'd known when you started investing, and what advice would you give to yourself if you could when you was just starting out?
In terms of what I know now that I knew when I started investing, I think for me the main thing is that there's no secret sauce to investing. So there's, I think when I first started investing, I kind of thought that there must be like a defined way of doing things. Does that make sense? Like there's only one possible way you could do investing, and you had to try and find out what that way was. So yeah, I think that's kind of how I started, and I was almost kind of searching for that rather than thinking about trying to find an investing style that suits me. So I think knowing that and knowing that there's many different ways to invest, and you've just got to find one that suits you. And I think if I was to give myself some advice, I would just say that you don't have to rush into taking a position, because the market will at some point more often not give you an opportunity to buy something at a reasonable price. But on the flip side, if you do get that opportunity, kind of go at something with a bit more conviction. Don't think you can take the time, and that opportunity will be there forever.
So how have you evolved as an investor?
I think my main evolution was, like say, when I first started out, I was just picking shares that looked cheap, and sometimes it worked out okay for me, but other times you're just kind of stuck with stuff in your portfolio that just goes nowhere, and you're not sure what prospects for that changing are. So I think for me, I've kind of focused more on kind of quality, trying to find quality shares at a reasonable price, and if I am going to look for something that's a bit more of a value play, just try to think about, what's the catalyst? Why would this re-rate?
Yeah, we get quite. It's a fairly common answer, actually. When we had John Kingham on, he basically said the same thing as well to that question. I think one thing that a lot of people learn the hard way is you can do very, very well with the value and the deep value, but a lot of the time it's cheap for a reason. I think the markets are fairly efficient with stuff like that a lot of the time.
I'd agree. I mean, it's cause you're a bit more of a growth investor, I get the sense, Sam. What's I'm interested to know what that same question would be, kind of, and how that'd be answered by someone who's a bit more of a growthy type investor.
I think the way I've evolved is I think when I was first starting out, I was very focused on diversification. So I put a set amount into the stock, like, well, I'm building up my portfolio, so I need to get another stock with the next amount. And it's like, I wanted to get to like 15, 20, 25 stocks. And then I got to a point where I was approaching like 20 stocks in my portfolio. And it was actually partly through doing these interviews, especially the Adam Mead one, because he only had like something like 6 or 8 stocks in his portfolio, which to me just seemed insane. But then when I was interviewing him, he was saying, well, how much money do you want to put into your 7th best idea? And I thought, well, that did resonate with me a lot. And the more I'd read as well, the more I thought, well, like, it's much higher risk, but I think if you want to beat the market, you have a better chance of doing it if you're fairly concentrated. It also means that if it goes badly, you're going to underperform a lot more. But that was a risk I was willing to take. So it meant that now when I see something where and a lot of it as well is from going back to and watching all the Berkshire meetings again. One thing that stuck with me was in the 90s. It was one of the 90s ones where Buffett was asked about sort of like basically how do you invest, and he said something along the lines of the best investments are obvious, and that's partly why I don't do discounted cash flows, because I think with an obvious investment you shouldn't need to. So it's kind of like, I guess when I looked at Ahdal Africa in detail, and you look at the growth rates of it, and there is some risks, but the thing's trading at 12 times earnings. It's like, I mean, if it's growing at 20-30% a year and it's at 12 times earnings, you don't need a discounted cash flow to work out. It's to me, it seems fairly obviously mispriced. So when I saw that one, it wasn't just, well, I'm going to make this the same size as my other positions. It was, I want as much of this as I can get my hands on. So with Ahdal Africa, before it started, I mean, I've not actually updated my portfolio for a couple of months because I was busy at the end of last month. But at the end of November, it was maybe like a 14% position size, and it was my second biggest. Etsy's been cut in half since then, so it's going to be biggest by default. But then it's gone up like another sort of 20-30% or so since then, I think. So I think that when I update my portfolio at the end of January, when we're recording now, I think it could be over 20% of the portfolio at this point, and that's what I've learned. It's more about how I've evolved. I'm a lot more comfortable making much bigger bets, but I'll only do it if it seems incredibly obvious. So like another stock that I was very interested in was Peloton. That was partly from the Flosser interview. And I liked Peloton, but it wasn't as obvious as Ahdal Africa. I thought there were reasons why the valuation could be justified and it could beat the market from where it was. So when I got in at about $90 a share, I only made it a 3% position, which for me is very small. And then luckily, that's all I did, because it's down about 70% now. And obviously, if I'd had the same level of conviction for Peloton as I had for Ahdal Africa, and I'd gone and made it a 15 or 20% position, that would have been absolutely catastrophic, because it would have taken me a year or two to just recover from that. So yeah, that's probably how I've evolved.
Yeah, it's almost, it's kind of similar, isn't it? It's I always find it's interesting that it kind of doesn't matter what, whether you growth, value, quality, or however you want to badge it. It's a similar thing, isn't it? That you kind of you should only really swing at what you think the fat pitches are, but when you get a fat pitch, you should make sure you really swing at it, isn't it? It's that kind of thing. And it's funny, Ahdal Africa's coming. I'd heard about it on the podcast and been having a look at it, and it's in quite a few of the Signet Group's kind of fantasy portfolios for next year. This year, sorry. So it's clearly starting to get noticed a bit, I think, now, which is interesting. So hopefully that'll work out. work out quite well for you over the course of this year.
Well, I hope so.
Yeah,
but
it can't go much worse than Peloton, can it, at the minute? But,
that's well, I don't use Peloton as my benchmark, unfortunately. Otherwise, I'd be doing pretty well with all the others. But I think as well, I do have growthy stocks, but I wouldn't necessarily categorize myself as a growth investor either, because it's like, if you look at Airtel Africa, it's the example I always use. If it's growing at 20-30% a year and it's a PE of 12, is that a growth stock or is it a value stock? Because I'd say it ticks the box for either. And there's some stocks I've got where they're obviously, I mean, Etsy, that would fall into the growth stock basket. But then something like Boohoo, where there is growth there, but it's trading at 12 or 13 times earnings. So I think I'd go back to that. I can't remember if it was Buffett or Munger that said it, but they are growth and value investing. They should be the same thing. I'd hope that my own portfolio reflects that. And I think some of them they're more tilted towards growth, but I wouldn't have anything in the portfolio. I couldn't sit there and make an argument for why I thought the valuation, why there was value there. So I wouldn't necessarily put myself in either bucket.
No, I agree. I mean, I use a lot of value style techniques, but I agree. I think one of the things I look at as well in one of my screens is the PEG ratio, which has kind of come from the Zulu principal books, and that's really all about getting kind of growth at a reasonable price. And I think I know Phil Oakley in one of his articles I liked was talking about how essentially quality is not enough. You need growth as well. So I completely agree with that. I think kind of arbitrary start. Yeah, people have more of a, they might favour certain types of investments more than others, but I think you're right. I think I agree with that kind of Buffettism that value and growth, really, there's no distinction. Every investment you make should really be based on value, shouldn't it? Otherwise you wouldn't be making that investment.
Yeah. It's like if you were to look at John's portfolio, John, like the last two stocks John bought were Airtel Africa and Boohoo. And for both of those, Airtel Africa has always been cheap as long as we've been looking at it. But I mean, Boohoo a couple of years ago, it was at 50 times earnings. It was very much in the growth field. But John does actually have the discipline to just sit there and say, well, it's too expensive. I'll look at it again in a year. And if it's been cut in half, I might consider it. And then he'll pull the trigger. And Boohoo's one that's fallen into that range. He would never have bought it at 50 times earnings as much as he liked the business. And then we've looked at it on the show, it's 12 or 13, and he's pulled the trigger. I wouldn't say he's a growth investor, even though it's growing at 25% a year, but equally, just because he sort of had a valuation, he's waiting for it. I wouldn't necessarily say that Boohoo's a value stock either. So it's a bit of a funny one, really, because like I guess the traditional conception of like value, well, for growth, it's maybe, you've got these like companies like Snowflake where they're at 100 times sales or something silly. And then for value, it's, you're looking for the thing where it's basically trading at like less than the cash on the balance sheet. And those are the two extremes. But I think in reality, you want some combination of the two.
Yeah, I'd agree. I've been having a long, hard look at Boohoo as well. And again, probably not learning one of my lessons. I've kind of not taken a position yet, just because I wonder whether it'll take I think they're trying to serve their American market by flying stuff over from the factory they have in the northwest of England, I think it is. And I think that factory is due to open later this year in America. And I do wonder if the share price has got further to fall, but I should probably listen to my earlier lessons learned and at least take a small position. There's just something about the Boohoo management as well with me that doesn't quite sit right with me. So I thought the whole stuff around the acquisition of I think it was the brand he bought from his son, was it Pretty Little Thing? And it's kind of some of the court cases for pricing in America as well, in California. But then again, I think if you look at, I'm kind of convincing myself back around the other way now, where if you look at those things, they're probably relatively small in terms of, small fry and not that serious in terms of what that business could be in a few years' time.
Well, I think like the distribution problems and the supply chain issues, to me, it's like me and John have both looked at that, and we both look at it and think, well, that is very much a temporary problem. That doesn't fundamentally change the investment thesis for Boohoo. You might have a couple of years where earnings are lower than they otherwise would have been, but that's not really, I mean, if you look at where Boohoo is and its growth, and it's still growing, even on a bad year, it's going to be growing 15%. that's not really why you're buying it. The margins and the efficiencies, they will come later. In terms of the management, I think James, who was 20s trader, and he's actually recently changed his username. I can't remember what it is, but I found it. He's changed it last night. But James, who was username 20s trader that we had on a couple of months ago, he gave a very good description of the Boohoo management. You do know what you're getting, and they will bend the rules a little bit. That is just what you're getting. But I think at a PE of 12 or 13, I think that's worth the risk.
Yeah, I think you're right. I know that I've never shopped at Boohoo. Although I do think they do a men's range actually, but I've never shopped. But I was always wondered what the quality was like. And my wife actually got some stuff delivered from there this week, and the value of it, and the product was good. So kind of after seeing that as well, I suppose there's a little bit of scuttlebutt in there. I'm thinking, yeah, it might be. I'm going to have another look at that, I think, more closely, particularly because I think currently in my portfolio, I've not really got anything along those lines, kind of, that British or even American kind of play on clothing, e-commerce and fashion, purely because it's, like you say, the likes of Boohoo and ASOS were just insanely valued when, at the peak COVID, the lockdown era. But yeah, part of me has thought about whether, I know ASOS has rallied a bit since it announced it was going to move to the FTSE, but I was thinking about taking a bit of a basket approach and just buying a bit of both. But I think I was always leaning slightly more towards Boohoo, because although I'd say ASOS management might give you an easier ride, I just think Boohoo overall is probably a better business and appeals more to that kind of younger demographic who do tend to spend more on fashion.
Yeah, I'd agree with that. I've just got it's not necessarily a rule, but one thing I've started doing now is we've got some companies where, if we'll cover them 2 or 3 times on the show and we're both saying we really like it, that to me, it's like, well, you need to take a proper look at that. And Boohoo is one of those. I'd say another one is actually the problems of valuation, but another one that I've just sort of realized has fallen into that camp now is probably E73, where we did it last week. And that's maybe the 3rd time we've covered it on the show, where we both said, well, this is actually a really good business now that we've gotten to understand it more. So on the surface, you look at E73 and you think, well, the evaluation is ridiculous. But when we've gotten to understand it, it's a business that we both really like. The problem is neither me nor John would pay 50 times earnings for it. But if we look again in 3 or 6 months and it's been cut in half, it's the sort of business where, like Boohoo, I'd probably think, well, I probably need to go for this.
I think E73's been on my watch list since I first started investing. It was, looking at the Peter Lynch thing, I thought, I like E73, and you're right, it's been on my watch list for years, and it's just never, the price has never came down to a point where I've even thought, it's not even where I've thought I could get it's a bit more I'd like to pay, but I could get comfortable with it as a long-term hold. I've just never been able to justify it. But then, if the American growth, which I have to say I was a bit skeptical about whether they would get as much growth in America as they were hoping for. They do seem to be executing on that, and you think if they kind of achieve the level of market share in America as to what they've got over here, then perhaps the valuation actually doesn't look too bad, even at what appears to be kind of very high on a PE multiple.
Well, that's the thing with E73. If you'd been waiting, I mean, we looked at it last week, and I think it had, since it listed, it's got an average PE ratio of 47. So it's just never been a cheap stock, unfortunately. But I can see how someone could make the argument for it at the current levels. But for me, it's just one where I just say, look, if it gets cut in half, I'll have a look at it. But otherwise, I wouldn't be sleeping well at night with it, I don't think, because it does have a long way to fall.
It does, and I think it's one of those, isn't it, where I always think it's telling when you get, I think E73 fell a bit off some kind of news that on balance was pretty good. And I think when you get, stocks that the share price drops on the back of good news, for me, I think that's always an indication that the market's a bit uneasy about the valuation.
Yeah, well, they're priced to perfection. That's the thing. What are the biggest mistakes you've made in investing?
I think for me, biggest mistakes is, I think I've already covered buying things just because they're cheap. But I think on the other side as well, ignoring my valuation discipline. I think for my psychology, in order to kind of buy a share, I need to kind of know what I think it's worth. Otherwise, I feel like I'm just buying things a bit blindly, and then price movements will kind of worry me. But on the same hand, there have been times when I might ignore it a little bit, but I think there's one time where I've ignored my valuation discipline and it hasn't worked out for me. So I think I've again, it probably goes back. I think really what that does say, it's not just ignoring valuation discipline, it's sticking to your process. And when I stick to my process, I tend to do a lot better and feel a lot more comfortable. And I think the other my other big mistake is just buying something you don't really understand. So I think earlier this year, I bought shares in a company called Architect, which is a smaller UK company, but it does kind of financial software. So by metrics, it looked okay. It had some kind of some good investors had holdings in it, but I couldn't get away from the fact that a lot of its products I didn't really understand, and the main one just seemed to be kind of aggregating financial data from other sources. And I thought, well, is that really that valuable a product? But I just got swayed by kind of the valuation and some of the other metrics like insider ownership and who else held it, and it's just been a disaster. It's like 50% down. The more I've looked into it, the more I've just thought I don't really know what this business is offering. I was kind of saved by the fact that when I don't fully understand something, I kind of kept my position size fairly small, but it's probably a good lesson to learn, and thankfully it hasn't been too much of an expensive lesson to learn for me.
What are your thoughts on current valuations in the US?
I think the US market at the minute is just hugely overvalued. If you look at the Schiller Cape, I think it's either second, it kind of fluctuates between the second or third highest in history after the dot-com boom and Great Depression, and it's higher than it was in 2008. And I just think at the minute, the American market is just too easy. You can almost, well, up until fairly recently, I have to say, up until the kind of tech corrections recently, it was just too easy. People could buy almost anything and it would go up, and I always think that's a warning sign. I think the problem is it could just keep going higher. You just never know when it's going to correct. But Japan, I think Japan got to nearly 100, but the kind of warning sign there is it's taking decades to come back. And I just think you look at some of the business, some good businesses I like, but they all have a story about how they're going to be, the next Amazon, and profits don't matter because Amazon didn't have profits. But whenever people say stuff like that, I kind of always counter it with, how many Amazons are there?
Survivorship bias.
Exactly. And the stuff I like, so like DocuSign, I think it's a good business, but I think it's forecasted to make a profit for the first time next year. I think it might be, unless the results that came out last week. But its market cap was 60 billion before it had a recent drop. And I think it's on a forward PE of 60 and a forward peg of over 6. And it's a good company and it might be successful, but I kind of look at it and think, is it going to be like one of those nifty 50 stocks where if you buy it now and hold it, eventually you'll do all right, but you're probably going to have to hold it for 20 or 30 years for it to properly grow into its valuation. I think like Peloton's a similar one where I kind of chose Peloton just because I thought generate some discussion. I know you've spoke about it, but I kind of like, it intrigued me and I looked at it, and the more I looked into it, even just without looking at kind of fundamentals, I just thought it's a bit of a fantasy stock because not only are the cost of the bikes and the treads ridiculous, but you then have to buy like a I think over here it's £39 membership, and I like working out at home. Like I don't like talking to people at the gym. I just like to kind of, do my exercise and just get it done. But I'm not the majority of people. Like my wife goes to the gym really so she can socialize. And I actually think the kind of market that Peloton's going for is kind of the same people who could pay less than 25 quid a month for a pure gym membership and get that social element as well. And I think it's not quite the same on an iPad. So yeah, I think that, I think you're either getting stuff like DocuSign, which is a good business, but very highly valued, or likes a Peloton, which I think was again, I'm not saying it won't be successful. Probably a lot of teething problems, but the story, particularly at the peak of COVID, is no one will go to a gym anymore because everyone's just going to buy a Peloton bike. And I just thought, well, no, I don't think that's quite going to happen. And I think that all probably links into, I think a lot of companies, perhaps not by private investors, but institutional investors, the discount rate they're probably using on valuations for the past 10 years in the US has been probably pretty much not more than zero.
I think with Peloton, one thing that surprised me is just how many people did want to go back to the gyms. I thought a lot of people wouldn't go back, and it actually seems to have been the opposite. People have been desperate to go back to the gyms. I do think the difference with Peloton is if you speak to anyone that's actually got a Peloton, I've not come across someone yet that isn't in love with it. They just think it's the best thing ever. So I guess it's more like, you can compare it to like the gym, but you've got more convenience with the Peloton. And then it's how much is a personal trainer worth to you? Because that would cost more than the $39 a month. And if you view it as like having that in your house and you've got the convenience and the fact that people are, I know it's come down now because we're not in COVID anymore, because it was people using it something like an average like 26 times a month or something silly. It's come down to like 16, 17. But how many people who go to the gym 16, 17 times a month? The average, I don't know what the average is, but I'm pretty sure it'll be a lot lower than that. So I think there is definitely something there. But I mean, when I bought it, it had already been cut in half. So I thought, oh, well, this looks a bit more reasonable, the valuation. And then it's dropped another 70% since. So it can always go lower, unfortunately.
Yeah, I think it's at the point now where I think Peloton does become a bit more interesting. But I think the directors, I know you've covered it on the previous podcast, but saying no equity raise, then we're going to raise equity. And I think quite a few of them offloaded shares as well, which I don't like to see. I think for me, for Peloton, I think if they can, it's the price point of the bikes and the tread. If they were more accessible.
They are coming down though.
Yeah.
But yeah, it's for me, the reason I've not added to it is the management rather than the business, because I think the business does look quite attractive now. We said that last time we covered it, but I think management's comments and behaviour puts it in the sin bin, unfortunately. So in contrast, what do you think of valuations in the UK?
I think the UK, I think valuations on a whole are fair. I know there's a kind of train of thought that people are saying that the UK is cheap, but I think some of our kind of more quality companies are kind of, I think they're fully valued, or you could say they're arguably overpriced. So there's a few things on my watch list that I like the look of, but you look at like Auto Trader, which is trading at about 36 times enterprise value to EBITDA. Rightmove 38 times on that measure. Spirax Sarco 30 times on that measure. They're good businesses, but I don't think they're cheap by any stretch of the imagination. And you look at something like Games Workshop as well, which I put that in the fever tree kind of bracket for me, which is something I like, but the valuations just never come down to something I can get comfortable with. And again, that's what that price seems to be wobbling a bit now. So I think the UK there's probably more pockets of good value, but I think on a whole, most of the kind of really quality stuff I think is fair value to maybe a bit overpriced. But what are your thoughts? It's certainly cheap compared to America, but I think pretty much everything's cheap compared to America.
I think it's definitely got less growth and less quality than America. There is a reason that America trades at a premium, but I think there are clear pricing differences. Like if you compare Unilever to its US peers, if you compare Diageo to its US peers, if you compare Boohoo to its US peers, and you can go down every stock in the FTSE 250, and there is a premium just for being listed in America. It's like when we first covered Airtel Africa, it was like, what the hell have they listed in the UK for? Because they could have got a much better valuation if they'd gone and listed over on the NASDAQ or something, if they'd have them. But yeah, I think what I like about the UK is I think the quality businesses, they're probably harder to find. I don't think you need to look. I mean, if you work down the S&P 500 by size, you don't need to go very far down before you see some very, very high quality businesses in there. Whereas if you go down the FTSE 100 by size, some of the bigger businesses, they are a bit, they're just sort of, I don't know, just sort of chugging along, but they're not really. It's like, I guess Unilever in a way, it's sort of like the last few years have maybe lost their way a little bit. Whereas, if you compare that to the biggest stocks in the S&P 500, if you look at Google and Facebook and Microsoft, they're just absolutely bombing away. And that's not really the case in the UK. So I think finding stocks like that and not even just the bigger ones. I think, the up and comers, so like what would hopefully be those stocks in the future, they are harder to find in the UK. In the US, you can find a lot of companies where, the valuation might be questionable, but you can find a lot of very, very good businesses in the US. In the UK, I think you've got to look a bit harder, but when you do find them, I think you are rewarded because I think the valuation is a lot lower. I'd be interested to know why you think Games Workshop is too expensive, because I think it's actually quite reasonable.
I think I've looked at it on my valuation measures, and I just find it fully priced. I think the thing with Games Workshop for me is there seems to be, I'm not convinced how many times people will buy things like figures, particularly once, we're out of lockdown and things open up again. I'm not convinced how that would translate to kind of expanding across the world. And I know there's a lot of kind of thought that their IP and kind of some of the kind of more TV movie type productions that might come out of that might help boost that as well. It's one of those. I mean, I tend to be. I have one of the things I look at is I try and avoid noisy stocks, as in like ones that everyone talks about. And if you go on to Twitter, it seems like pretty much every private investor on Twitter owns Games Workshop, and for me, that's always just a bit of a sign that I think something's running away with itself. But I just think Games Workshop on that peg, on that kind of price earnings to growth ratio of over 5. That's a lot of growth already priced into the current share price. Not to say it can't do it, but I don't know. I think there might be another bump in the road or two for Games Workshop. It may. If I was a betting man, I'd say it probably will do very well over the next few years. But I do think it's probably due a setback or two.
Yeah, I think the thing the Games Workshop is the valuation. I think it's reasonable, and I'd actually say it's cheap if you believe they can crack the international growth. But if it's just more of a UK story with not that much international growth, because there's a lot of stocks on the FTSE where, they do very well in the UK. But I mean, like if you look at Domino's, the UK listed one, they do very, very well in the UK. And then they tried to go to some of the Nordic countries and they just botched it. So it's if that was to happen to Games Workshop, where the expansion into Asia wasn't to work and they're just left with the UK, then at that point, it's quite expensive. So I think, it does just depend on how well you think they can execute that.
I think that if is just such a big if for me as well, because I think it's you look at Warhammer, and I don't play it, but I know how well entrenched it is over here, and I just wonder if like going into kind of Asia, is there an Asian equivalent of Warhammer? The answer is I don't know, but for me, there's almost that something of the hobby like Warhammer, you almost there's a cultural, almost like a cultural barrier, I think, to overcome as well, as to whether the culture would embrace that kind of game, or whether it has something that already fulfills that's already kind of well established, and can Warhammer kind of take market share from it. So it's that, you're right, if it does that, then it does look cheap, but that if just feels like a bit too big an if for me. I'd need to look into it more, I think, but it just does seem like quite a big if at the minute.
How do you think about allocation and position sizing?
So in terms of, I'll start with position sizing because that's a bit more straightforward. So I tend to kind of scale into a position. So I might, kind of start a position of, say, 0.5% to 1% of my portfolio, and then I'll scale in. I'm happy for my original kind of buy price to get up to 5% of my portfolio. And I tend to scale in for two reasons. One, just because you can never call the right time to buy something. And when you're funding your portfolio from your monthly wage anyway, that generally tends to mean you have to scale in to a degree. Once my kind of original buy price is at 5%, I tend to leave it there, but I will let something grow organically as big as it needs to, provided that I'm still happy with the investment. And I think it's just like letting your runners win. I think I'm just, I think I can't remember it might have been Flosser who was on here who just held on to Tesla. I mean,
He's still holding as far as I'm aware.
Yeah, exactly that. I mean, me personally, I'd never have bought Tesla, which just, again, there's a lesson
You
for me.
sold it
I know it's
100 times
ridiculous.
along the way.
Yeah, but I think, again, it just shows with him, like, the fact that he held, to hold on when it's 10x and just saying, nope, I'm going to keep holding it, like that has just been an absolute brilliant call for him. But again, that was kind of one of the lessons in 100 baggers. You need to, if you're going to get the 100 baggers, you do need to hold them. So yes, I'm prepared to let it go. I think in terms of allocation, I tend to be just in. I mean, I think bonds at the minute, with the way they're priced, I don't really have any bonds allocated in my portfolio. I kind of aim to try and spread across a list of different sectors, but I will only do it based on when the opportunity's there. So, we'll come on to talk about probably REITs a bit later, but kind of pre-COVID, I thought having a bit of, having REITs fulfill a different kind of objective in my portfolio and bit more inflation protection, but they were just expensive as people were charging into income. So I never had any. When the pandemic hit, I got that opportunity, so I took it. So it just tends to be equities kind of across different sectors when the opportunity's there. And I also kind of try and get worldwide exposure, mainly through, I'll buy American shares, and I'd probably be confident buying European, but I think beyond that, I tend to use primarily investment trusts to try and get some worldwide exposure as well.
How much time do you spend a month on investing in your portfolio?
In terms of investing, I mean, if you include podcasts on that, I probably, I'll listen to an investing podcast pretty much every day, because I tend to be the cook in my house. So when I'm cooking, I'll just have a investing podcast on and listening to that. I think I tend to read, probably spend at least half an hour to an hour reading every day about investing, whether it's books or articles or blogs. So I probably say at least probably 1 to 2 hours a day on average. I might do a bit more at the weekend, a bit less during the week. In terms of, like, before I take on my portfolio, I'd say I spend more of my time kind of up front before I take a position. So I might spend, a good, can't say a minimum of 4 hours researching an individual stock before it goes into my portfolio. Quite often a lot longer than that. But once it's in there, because I've done the research, it tends to be more just a case of, keeping an eye on the RNSs, seeing if there's anything worthwhile about any of the kind of news boards every so often, and just it becomes kind of almost low maintenance once it's in.
Do you read much outside of investing?
I do. I read quite a lot. I've always been a big reader, so I'll read all sorts outside of investing too. So I quite like, sorry, name escapes me now. It's the guy who wrote, just out of mind, like Gladwell, Gladwell, who wrote things like Outsiders and stuff like that. Outliers, that's it. Yes, yeah, I quite like his books. Some of Michael Lewis's other books, kind of the non-finance ones, are good. But I'll read all sorts of, I read sport books, read a lot of, I'll read fiction as well. So again, I quite like in terms of fiction, Kishi Ishiguro, who wrote things like The Remains of the Day. I quite enjoy his novels.
I've got that on my shelf as well to read.
It's a really, I mean, I really like his style of writing, but it's a very good, it's a really good book. I mean, the way for me, I suppose I've always been quite interested in human nature, human behavior, human psychology, and there's a lot of that in his writing for a fiction writer. It's not set out to be like that. He's telling a story, but he's essentially telling a story about people and what people are like. So I've always been interested in that, and I like Orwell as well. So I like, I've read a lot of Orwell's, obvious famous fiction books, but his non-fiction is very good as well. So things like The Road to Wigan Pier and Down and Out in Paris and London. I quite like a lot of Orwell's books, but yeah, all sorts. So I've got a bit of a soft spot for dystopian, futuristic fiction, anything kind of human psychology based, and yeah, just pretty much.
You read 20,000 Leagues Under the Sea?
Do you know what? I haven't.
I'd really, if you like sort of dystopian stuff, I'd really recommend that. That was like meant to be the first sci-fi novel. And it's just really, I won't spoil it or anything, but like what it's about, like technologically, is not that impressive now. But back then, it was like the wildest thing they could imagine. But back like I won't spoil it at all. But it's a pretty normal thing. What like this sort of this dystopian thing is. But it's definitely, it's a very good book. Actually, I would recommend that if you like that sort of thing. Anyway, back to the interview. What are your thoughts on Bitcoin as an investment?
I think it's fair to say that I just don't understand Bitcoin, and I've not done like I don't think I've looked into it enough to really have a solid opinion on it. So it's not something I own. For me, I tend to want to own productive assets, and I know essentially people say Bitcoin's a digital gold. I don't know a gold either, so it's not. I do have a Coinbase account with nothing in it because I heard a guy on it might have been the Robert Kiyosaki's podcast actually. There was a guy who was saying that his prediction was that Bitcoin was going to get to all-time highs, plummet to being virtually zero, and then rocket back from that. So I thought if it ever gets back to the point where it's virtually zero, I might buy £10 worth of my Coinbase account, and then if it rockets back to what it was, I'd have done very well. But no, I just don't know enough about Bitcoin. I think you probably know a lot more about it than what I do. I think you and Jonathan both have a position, don't you?
Yeah. I actually sold mine in the summer because I thought I might use it. I might need the funds personally in the next year or so, but it's crashed again now. So I've decided actually I can do without that. So I actually bought some back. John just averages in every month. If you do want to learn, I'd recommend there's a good book called Digital Gold by Nathaniel Popper. And that's basically what it is. It's just a biography of Bitcoin from like inception. And it goes up to about 2013. But it just sort of talks about how it came about and sort of what the thinking behind it was. But it's what's really good about it. It's not like an overly technical book. It is basically a biography, but instead of being about a person, it's just about Bitcoin. So that's a very, very good book, actually.
No, I'll check that out. That'll be interesting. I know I was reading something where some guy reckoned it was essentially started up by his theory was it was started up by the secret services in America and the UK as a way of testing what digital currency was like. So I found that quite amusing, but I don't really go in for all the conspiracy theories.
No, I don't think we'll ever know how it came about. Because obviously, if Satoshi, whether they're a person or a group, if they wanted to reveal themselves, I think by now they would have done. And with the amount it's worth, I mean, if you look at Satoshi's Bitcoin, Satoshi has about 1% of all the supply sat in their wallets. And if they've not touched them yet, when are they going to? Because I don't know what Satoshi as a person or group does in their normal lives if they're still alive, but I can't imagine they're worth 1% of the Bitcoin market cap. So it's like to have that level of wealth and not touch it, to me, suggests they probably never will.
Yeah, it's one of those, isn't it? If someone came forward or a group came forward and said, I or we are Satoshi, no one would probably believe them anyway.
Well, you could prove it though, because all they'd have to do is make a transfer. We know which wallets are Satoshi's wallets. So you can actually, so so people have come forward and then it's like, well, all right, we'll just move some of Satoshi's money from one wallet to another. And it's on the blockchain. Everyone can verify it's Satoshi then. And no one's been able to do that, And the thought that Satoshi can't access their own wallet just seems a bit too implausible for me.
Yeah, maybe he's like some other people, and he's
it's just all on a hard drive in a dump somewhere.
Yeah.
Maybe we've finished the questions which are more about your general philosophy, so we're going to move on to the questions that are more about your portfolio. So first thing is you've got your concept of FU money before 50. Could you just explain that and what you need to do to achieve it, and also talk about how it's going? Because so far you have actually exceeded the target you need to hit to do it.
Yeah, I think this is driven by the fact I don't it's not like I don't like my job, but realistically, like I want to live a life where I don't have to wake up to an alarm. I can just get up and do whatever I want to do. So I came up with this concept of having FU money by 50, which means that hopefully by the time I'm 50, I'll have enough money where, I won't necessarily quit my job or retire, but, I could go down to part-time. I could, do whatever I want realistically. So I worked out how much I need a month to kind of live the kind of normal life that I do. So, having a couple of holidays a year, eating out occasionally, that kind of thing, paying my mortgage. And that gave me a figure per month. And then essentially I worked backwards from that. So I worked out what that would be in a year. And then based on kind of roughly the 4% drawdown rule, what that kind of then turned out in terms of a lump sum. So from that lump sum, I then worked backwards and thought, if I put X amount into my ISA every year and it grows by, what percentage does it need to grow by to get me to my FY money by 50? And for me, that figure was 10%. So it's kind of, the discipline there for me is then trying to make sure I achieve at least that 10%, and also making sure that I put that amount that I need to into my ISA every year. And you're right, past 3 years I've managed to put in both the amount and achieve over the 10%. So hopefully in just over 11 years time, if I'm in a work meeting and I don't like what I hear, I can just say FY and I'm gone.
How does the SIP interact with that? Is it just you just need 10% from the ISAs and the SIP's a bonus, or does the SIP factor in?
No, the SIP's just a bonus. So it's a collection of old workplace pensions. So I think I kind of, without realising it, I think I was quite lucky. The first job I got after leaving uni, the company I worked for, this was before the time of auto enrolment, but one of their perks was that they're paid 7% into a pension. So you contributed nothing and they're just paid 7% into a pension. So, I was like, oh, great. But, when when I was in my early 20s, it didn't really mean anything to me. So I've had this kind of pot that's just built in passive investments over the years, and that's not in my FY by 50 strategy. That's just a bonus for me. I figured that that'll kick in late 50s, mid 60s or something, and it's just an extra source of income, but I didn't want to rely on it because at least with an ISA you can access it whenever you want, whereas with your SIP, I think you have to wait until you're 55, and there's talk of that getting higher, I think.
Yeah, it's going to 57, which I think by the time you get there, it will be. And they might have increased it again. You don't know.
Yeah, I don't think you can. I've kind of viewed the fact that if I'm allowed to access a pension kind of at any age before 70, that's probably a bonus.
You say you have 3 ways of selecting investments. So could you briefly talk us through them?
Yeah, so my kind of 3 investment approaches. The first one's very much kind of influenced by kind of Phil Oakley's How to Pick Quality Shares. So I'm looking for effectively quality at a reasonable price. So something that's profitable and growing, revenues and profits are growing, generates cash, it's got good profitability margins, debt's low or manageable, you've got some good insider ownership, and ideally I can get it at a reasonable price. My second approach is more of a approach based on where I think the market reaction to a share or a sector is overdone. So again, I think Phil Oakley had said that he said that he doesn't think that markets are based on long-term aspirations. It's kind of the reaction's always either too positive or too negative. So for instance, kind of commercial property REITs, when they got hammered at the start of the lockdowns, I kind of looked at some of them and thought, have the prospects for this business really, diminished by this much, or in a few years' time, will be pretty much back to where it was. And so I'll do that. And I think, again, Boohoo probably fits that category now at the minute. And again, I'll choose a basket approach. If it's generally across the sector, I'll look at which ones fill more of my kind of QARPy criteria, and the ones that do the best on that, I might select them. And then the third one, this is more to get world or thematic exposure. So using investment trust funds and ETFs to kind of get world and thematic exposure, which won't, harder for me to do, I think, as a private investor.
Could you talk us through your golden rules as well then?
So yes, my golden rules are, the first one is patience. So again, Buffett quote I like is that the stock market is a device for transferring money from the impatient to the patient. So I very much take a position on the long term. I think if you want to get the value from an investment, really you should be looking to hold it for a minimum of 5 years, ideally 10 plus. this does cause some consternation in some of the Signet groups where people are a bit more kind of active. But my point is that I'm not blindly holding. It relies on the prospects for that business being the same and management executing. But, I think it's been shown that you have to be patient. I think, you look at Microsoft, I think at the turn of the decade, Microsoft had about 10 years where it essentially went nowhere. So I think patience is key. And the other one for me is valuation. And again, I think it's probably another Buffett quote where he just says essentially for the investor, paying too high a price for the stock of even an excellent company can undo the effects of a decade of good performance. So for me, it's about buying something when I think it trades at a discount to its intrinsic value, just to bring in that margin of safety.
So your portfolio has a lot of funds and trusts in it. Have you considered just having index funds instead? And what's the logic behind having all those funds and trusts?
So I use my funds and trusts. They're there to do a different job to what a passive index would do. So I'll run through a few of them and just kind of to give a flavour of what I'm aiming for there. So one of the UK funds I own is the Lindsell Train Investment Trust, which is one of Nick Train's. Now, I chose that one specifically. I think he's got his like Finsbury Growth and Income as well. But the reason I told that one is not because I want exposure to the type of kind of, he's kind of got a bit of a Terry Smith approach to investing, not because I want that, because if I did that, I'd probably go and buy Fundsmith, or like you say, just buy an S&P 500 tracker. But it has, I think nearly half of Lindsell Train Investment Trust is in Lindsell Train, the asset management company, which I think has been its best performing investment pretty much forever. So when that got discounted in the kind of COVID correction, I bought it, but I bought it because I wanted access to that particular asset management company. A few of the other ones I've got Fidelity China Special Situations. And the reason I've got that is, again, it does something different to the index. So it can hold unlisted Chinese shares. So I think it basically had an investment in ByteDance, which isn't public, which has done very well for it. And also, if you look at the Chinese index, beyond the kind of obvious names, there's quite a lot of finance and property stocks in there, and Fidelity China Special Situations is underweight those areas, which is, again, in the context of the evergreen issue, has worked out quite well. The other thing I'll look at is, I've got a few ones that offer private equity exposure, just UK and worldwide. So I've got HG Capital Trust, Augmenting FinTech, Harbourvest Private Equity. They've all performed very well in the past. I think, particularly HG Capital Trust and the Harbourvest Private Equity. And I think the Harbourvest ones, it's got a great record. It's I was picking it up when the discount to NAV was like more than 20%, and it's got kind of loads of effectively unicorn businesses in there. And again, I've got Utilico Emerging Markets Trust, which hasn't done well, but it's a focus on utilities and infrastructure in emerging markets, which is a bit more of a defensive play, but again, not the kind of thing you get from an index. And I like to think I've got indexes covered in my SIP, but I do think there is a danger in certain indexes now. If you look at kind of like the S&P indexes, you kind of just get in nearly 20% of that index is in like just 4 or 5 companies. So I think a lot of people probably aren't as diversified as they think they are in an index, depending on which one they've picked.
Well, that's partly why I don't. John uses a world tracker for a lot of his investing, and for me, a world tracker makes me uncomfortable because you end up with like a 60% weight into the US, which is not really where I'd want to be. So with my indexing, which is done through my pension, I've just got 5 different indexes. One's UK, one's developed Europe excluding UK, one's emerging markets, one's North America, and one's Asia Pacific. And it's just a flat 20% in each of them. So I'm still getting the US exposure, but it's at a level I'm much more comfortable with. So yeah, I think there is a danger with the S&P and the world indexes, isn't it?
I completely agree. I think, particularly if you're concerned about valuations in America, the world indexes are going to take a hammering if that does. But your approach there, that's exactly what I do for my wife with her pension and her ISA, because I've kind of persuaded her that she should be investing as well. But I kind of not brave enough to kind of make the same kind of investments I do with hair accounts. So I've just took exactly that same approach that you've described there.
Because I think with the US, it could do, it could have another 10 or 20 years or it carries on as it is. We could be completely wrong. And if you're still 20%, you're going to do fine. I mean, you're not going to do as well as if you're 60%. But then if a lot of growth has been pulled forward, which I think it has, then you could have a decade or 2 decades of underperformance in the US. And if that's 60% of the world index, yeah, it makes it very, very difficult for you to get a good level of returns.
No, I agree. I do think there's, I see it in the FIRE community, which is the financial independence, retire early community. A lot of them, particularly American ones, they just invest in the S&P tracker because they say, oh, well, the business in the S&P, they're almost worldwide anyway. So you get worldwide exposure through doing that. But they're kind of basing it on the view that, historically, that's returned 7% after inflation. But I think there is a danger that people aren't thinking, well, if I've been getting a lot more than 7% after inflation over the past decade, at some point that's going to mean revert. And that means you're getting less than 7%.
Exactly. It's not a flat 7% a year, is it?
That's it. And I do think there is a lot of people out there who just think that you are going to get a flat 7. And kind of anything over that's almost like a bonus. And I just think that's quite a dangerous view to hold.
So could you talk about the REITs that you hold and why you've chosen to include them in your portfolio?
Yes, yeah. I looked at REITs kind of a few times because I just thought it is a different asset class. And I thought as an inflation hedge, things like rents tend to be inflation linked. So with a REIT, the income from it will probably increase with inflation. They were always quite expensive because I think there was a lot of income seekers in the UK. So a lot of them were kind of trading at more than NAV. But when the first kind of lockdowns hit, the REITs got hammered. Well, some of the REITs got hammered, particularly the commercial property REITs. And I had a look at them, and actually I thought I think the market reaction here provided something of an opportunity. So I've got 3. One of them, Secure Income REIT. It essentially owns travel lodges, kind of Merlin theme parks, some London conference venues. And at the time I was looking at Travelodge, they were looking at replacing Travelodge, but they went into a CVA and decided to keep the agreement in place with Travelodge. And at that point I was thinking, well, they've got Stonegate pubs, they've got conference venues, they've got travel lodges, they've got theme parks. Are any of these things not going to be around after the pandemic? And my view was no. They were quite well managed, and I think the asset manager has a big position in it, and I think they hold more than 10% of that REIT. So I bought that, and then kind of ones that were kind of a little bit more risky, Regional REIT, which is one that offers office space kind of outside of London. And then I've got Schroeder Real Estate Investment Trust as well, which is, again, mix of commercial and industrial, but again, focuses on a spread of properties around the UK, but with a focus on what they're called winning cities, which is essentially just your kind of big growing cities, your likes of your Birminghams and Leeds and Manchesters. Again, they'd all been quite beaten down, and I looked at them, and the kind of the loan to value on the property was below 100%, and you could pick them up quite cheap. And I looked at it and thought, well, as my company moved office in the pandemic, and they've kind of reduced the number of desks, but the overall space has got bigger, because people, even before the pandemic, people were wanting more kind of, collaboration spaces, breakout spaces, that kind of thing. So I was thinking, well, hold on, okay, people going to be going into the office 5 days a week? Probably not, but it was heading that way anyway. But is office space getting smaller? Not from what I could see, because although rather than being kind of in rows of desks, you still had fewer desks, but you had more floor space. So again, I kind of snap them up on that basis. And I think if the yields get back to what they were kind of pre-pandemic, based on my purchase price, I think Regional REIT would give me just over 10%, and Secure Income and Schroeder would give me kind of 5.5 plus. And when you're just aiming for 10%, if you can get those kind of yields, that does most of the job for you. And I think it's kind of, since I've bought them, Regional REIT's up about 15%, Schroeder 20%, Secure Income REIT 40%. So at the minute, it's looking like my hypothesis was okay, but it was kind of an opportunity just based on a sector I thought the market reaction was overdone to. I mean, I wouldn't have went out and bought anything that was commercial property, which was, city centre retail, but there was, under the kind of headline of commercial property, there was a lot of different types of commercial property in there. And I think the market just presented that opportunity, which I was happy to take.
Got very few individual shares in your portfolio. Obviously, the target for FUM by 50 is 10%. Is that just a target and that's it? And you're not bothered, if you did underperform the market? I'm not suggesting the market is going to exceed 10% over the next few years, but I guess with fewer individual shares, it makes it a bit harder to beat the market, if that makes sense.
Yeah, I mean, I'd agree. I am just aiming for 10%. So I think I will have more individual shares kind of longer it goes on, because I tend to do a lot of research before I'll take a position. And then when I do, I want the valuation to be right. So it means that I do add things very slowly, because I like to, once I've got that initial position, as long as I like it and the price remains favourable, I like to scale in. But I am purely aiming to hit 10%. I mean, over the past few years, I could have bought an S&P tracker and done better, and it'd have been a lot easier. But I do think as well that at least with me kind of knowing the thesis for while I'm invested in these things and what I think fair valuation is, it helps me ride out the dips. But I do think there'll be times when certain positions I have kind of outperform the market. I think my portfolio might be a bit more defensive in that, if you did get a big correction, like the big tech correction didn't really affect my portfolio as much. So I'm kind of protecting that 10%, which is really my aim. I suppose I'm doing a bit of a old Jose Mourinho kind of park the bus portfolio, try and get a minimum of 10%. And if I can pick up a few more percentage performance on the counter attack, then great, if that makes sense.
It makes perfect sense. No, I like that analogy. What do you like about Howden Joinery?
Howden Joinery, I just think it's a really good business. So first and foremost, when I looked at Howden, it's a product that everybody needs. And I think anyone who owns a house for any length of time has probably visited a Howden's or thought about it. So it's kind of what it does is, for people who don't know it, it does joinery products for kitchens, but it includes kind of units, flooring and appliances. And in terms of the market, I think it's the number one kitchen supplier in the UK, and everybody needs them. So if you're building a new house, you can put a Howden kitchen in it. I think builders probably do use them. If you've got an old house, you can put a Howden kitchen in it, so it's somewhat insulated from the kind of new build property market. I like that it's trade only, so people, if you buy a Howden kitchen, you only sell to the trade, so they'll go and design a kitchen for you, but then you have to go and find a tradesperson to install it. And the reason I like that is that you haven't got the risk of keeping that trade labour force paid and employed, and the way wages for kind of people working trades has went in the past couple of years. I think that's a good thing. That's insulated Howdens from that wage inflation risk in that skilled market. But also, I think it just, the means of not, if you get a shoddy tradesperson, of which there are a few out there, it doesn't really take the Howdens brand. Whereas if you went to, say, B&Q and you had to use one of their kind of kitchen fitters and they didn't do a good job, you're less likely to go back to them. Whereas I think the Howdens, anything, unless you don't like the product, if it's the installation you don't like, that's not really attributable to Howdens. So again, it's a high quality business. It's got double digit ROAS, CROCI, EBIT margin, had a cash position of over 400 million, I think, in 2020 in the last trading update. I started picking up in a COVID crash. Should have bought a lot more. I just thought I'd have longer to scale in, and I didn't. I'd say it's probably fairly valued now after a recent drop. If it comes any lower, I'll add a bit more. I think the management team are doing a bit of a share buyback. I wasn't really convinced on that at the high levels, but now it looks like it makes a bit more sense. But that's why I like Howdens, essentially. Is there ever anything you've looked at? I think it might have come up once or twice.
We've done it once on the show. I remember it being, I think it was a good business. We've only covered it once. It's like 10 or 20 minutes. I remember looking at it and thinking it was a bit expensive. I think I struggled as well because I'd never actually been to a Howden, so I did struggle to like visualize it. But yeah, what is the valuation like?
Well, the valuation was just pull up SharePad here, but I think I was lucky in that it was on my watch list, and in the COVID crash, I just thought again this isn't going to have an impact on Howden's long term. But so according to SharePad, Howden's at the minute, yeah, it's kind of trailing 12-month normalized PE is 18.8. So
What's the growth rate
not
like?
horrendous. Growth rate is, I think, let's have a look.
Just turning into a normal episode.
It is. I think growth's been a bit lumpy. So I think revenues have kind of had a bit of a dip in 2020, but obviously have ticked on quite a bit during COVID. So I think it's a bit lumpy, the growth rate. I'd need to look into it a bit more, but it's kind of a solid business. I mean, if you look at the overall trend of kind of profits and revenues, it tends to be upwards. There'll be the odd year when it drops down a bit. I do wonder if kind of, I suspect a lot of people have been out and bought new kitchens over the past couple of years. And I think there's only so many times you can buy a new kitchen. So I do wonder if over the next year or two, you will see a bit of a drop in growth for Howdens because people have essentially just brought purchases forward. But if that happens, I'd see that for me as an opportunity to try and add a few more.
What do you like about Alibaba? That's one we have covered a couple of times on the show.
Alibaba, I just think it's for me, it's a classic. The Buffett. Everyone agrees with Buffett. You should buy wonderful businesses at a fair price, and I think everyone agrees with it, but then says how hard it is. And I think the reason that's hard to do is that when you can find such an opportunity, the market doesn't make it easy. I think Alibaba is a wonderful business based on what it is now. I think at probably more than a fair price, but I think given the kind of Chinese government tech crackdown and the tension in America, people have been kind of abandoning it. But I think it's a high quality growth business. I think the level of growth, I think it did 29.4% revenue growth in the last year. And if you look at the chart and SharePad of kind of revenue growth, it's almost exponential. It's just the kind of graph you like to see.
It's a monster, isn't it? It is the Amazon of China. It actually lives up to that as well.
It is. And I think what really drew me to Alibaba is I was looking at the kind of segment revenues. And at the minute, I think it's something like almost 80% of the revenues, or more than that, nearly 90% of the revenues and nearly 100% of the profits are coming from the commerce business, which is growing at a great rate, the commerce business. But then if you think about, the kind of cloud computing business, if that even does half of what web services do, the fact that you're not seeing that really much in the revenue line or the profit line at the minute, that to me is just a huge opportunity. And I think it's that kind of, it's a kind of investment, the kind of heads I win, tails I don't lose too much. I mean, if the cloud computing business is a disaster and does nothing and you eventually wind it down, which I don't think will happen given that it's already generating revenue. But even then, the share price at the minute's worth it just on the scale of the commerce business and the performance of that. So I kind of see it that you're getting a cheap e-commerce business, but then you've got all these other things like they've got a whole other revenue line that's just innovation and others a bit like the kind of Google other bets line. And I just feel like you're getting at the minute for the price, you're getting a good and growing e-commerce business with all this other really interesting, potentially high growth businesses thrown in for free. And it's interesting looking at the price compared to peers. So it's probably a bit out of date, or I think it came from Seek and Alpha article, but Barber's like trading at lower price to sales and the likes of eBay and Etsy, a lot less than Mercado Libre, which I already like, but its growth is more than nearly 3 times that of eBay, nearly twice that of Etsy. And you just think eBay and Etsy fine businesses, but you just think are there better businesses than Barber, and should there be more highly priced than Alibaba? And that's kind of where I got to. And it's got compared to its market cap now as well, it's got a lot of cash on the books too, because it's hugely cash generative. So that's that's why I like Barber. It was interesting. I was talking to a few people in Signet about it, and they were concerned about it delisting. Like, did you hear about this?
Yeah, it
business
might list in
DD that
Hong Kong.
delisted?
Yeah.
Yeah. Well, I mean, all I did is I just got my broker, Interactive Investor. I just dropped them an email and said, like, if this happened, if they delisted and did what Diddy did and moved to Hong Kong, what would you do? And they just essentially said they'll just switch my holding to the Hong Kong entity. And I thought, well,
that's all right.
Can't really argue with that. It doesn't feel like much of a risk to me. So it's funny because you get a lot of people now who kind of speak up on. There seems to be a lot of like Western people who are now experts on Chinese government policy. And I kind of looked at it and thought, well, one, there's probably people quite high up in the Chinese government that don't really know what Chinese government policy is going to be. But two, given the amount of wealth that Alibaba brings into the Chinese economy, Chinese government is quite pragmatic in that sense. It recognizes what capitalism has done.
It's a goose that lays the golden eggs, isn't it?
Exactly. Yeah, exactly that. You're not going to kill the golden goose. Couldn't have put it better myself. So no, that's why I like it. I mean, what are your thoughts on?
I really like it. I think we put it in the fantasy portfolio. I'm terrible at remembering stuff like that. I'm pretty sure when we updated the fantasy portfolio, it went in. It's a stock we've looked at on the show and we've both liked it. And when we first looked at it on the show, I think the PE was something like, it was in the 20s and we were saying, bloody hell, this is cheap. But then it's dropped to something like 15 since then, which is, it was definitely in the teens when we put it in the fantasy portfolio. It was only about a month ago. But I just think, for me, I mean, the business I think you've covered, it's an absolute monster of a business. I think there's nothing wrong with that business. It is a fantastic business. I think for me, Alibaba is a very good example of the Buffett quote that nothing changes sentiment like price. I think if you saw the price run back up to $300 a share, you'd see people becoming a lot more optimistic about it on Twitter. I think a lot of the tune will change a lot. They'd find reasons to like it again. But no, I think it's a fantastic business. And I think there are definitely risks associated with it because you just don't know what the Chinese government's going to do with it. But, a PE of what is it? I'm going to guess 17 or something at the minute. But, for a company growing at 30% a year with the margins it's got and all I don't see how that's not priced. It might even be lower. It might be something like 13. I might be getting it wrong, but it's incredibly cheap for what you're getting. And it's a lot cheaper than, the best comparisons I think would be the FANG stocks in the US. And it's cheaper than any of those. And it's putting up growth rates that can match any of them.
Yeah, I completely agree. I mean, it's looking at share pattern, it's got like a trailing PE of 16.2 and a forecast 2022 PE of 13.9. So I just think I can't recall ever seeing a business like this trading at this kind of price. I mean, I've hit my maximum kind of position of 5%. I'd love to add more, but you just never know what's going to happen.
You've got to be disciplined with it. Yeah,
exactly. That's it. Yeah, I don't want to what's your portfolio look like? 100% in Alibaba, like that's you're not going to rest very comfortably with that.
Doesn't sound too far off what the Daily Journal's done with Munger, does it?
It doesn't. I was kind of, it was one of those where I thought, well, if this all blows up and I look stupid, at least I'm in good company if I look stupid.
Yeah. So why do you like Aviva?
Aviva is one that, so this was a bit more of a value play. So it was actually a first individual stock that I bought. I bought it in 2019. And again, when I was thinking about it, I thought, well, everybody needs insurance. You have to have insurance in a lot of cases. And there's only so many providers you can go to, and Aviva are kind of very big and well established. And again, pensions as well. Again, you kind of, with direct enrollment, you have to have pensions. And I actually think that workplace and pensions will start to increase the amount that people has to put in. So I think we kind of stole the Australian model, and the Aussies have to put a lot more in. So I think over time, particularly with people living longer, contributions will increase. So I kind of like the tailwinds for the business. And I thought workplace pensions tend to go for the big providers like your Aviva or your Legal and General. So that was a kind of high level look at it. But what caught my eye at that point, when I was a bit more of a kind of deep value investor, was that it was trading at a discount to peers like Legal and General and Prudential as it was then. And when I was looking into it, the reason seemed to be that the chief exec of Aviva had left in 2018. I think he'd done a lot of the digital transformation, and that they had a standing, and they'd had a standing for nearly a year, and the market didn't like it. So I looked at it, and thought, well, this thing probably isn't going to grow much, but I'll put it through my discounted cash flow, and just thought, right, I'll just say term will grow 3%, nothing more. And based on that, it was showing that the shares should be valued at just over £5. So I thought, this is a huge margin of safety. I'll buy into it, and I'd hope that when they get a new chief exec, that would offer a catalyst. And I think this is probably comes back to being patient. So they appointed a guy called Maurice Tulloch, who was already a director, and he announced this review. And at this point, I'm thinking, great. And the share price starts to rally a bit. And he conducts his review, and his review effectively says, nah, I'm not really going to change anything. So I was like, all right, well, great, called that catalyst wrong. But then I thought, well, I'll keep it anyway, because I'm getting a decent dividend yield, and if nothing else, it'll sit there till I've found a better idea. But then he had to step down for personal reasons, and a woman called Amanda Blank, who was a Ned, but she had experience in the industry, took over, and she took completely the opposite approach to what Maurice Tulloch had done. So she said she was going to focus on core markets, and she sold off lower performing parts of the business, and then she was going to return that value back to shareholders by share buybacks and dividends. And at the same time, she's looked to further digitalize things and reduce costs and dispose of some of the physical property office space. So kind of my theory with Aviva is that it's going to be a smaller business because they're selling off parts of it, but the share count's reducing in line with that through the buybacks. And again, I like to see buybacks at a discount to intrinsic value, which is what they've been doing. But it's going to be kind of a better business, so smaller but better, higher margin. And I think if we see that, the share, that's positive for the share price. And I think they've got an asset management arm that seems to be really focused on, called Aviva Investors, which I think offers potential for growth and again a higher margin. And that's becoming increasingly active in things like property and the infrastructure investment space. So things like kind of build to rent and infrastructure investment, and after it kind of went nowhere since I held it, and then kind of in late 2021, as these kind of business sales and the share buybacks and things started to be noticed by the market, the share price started going up. I think it's about 20% up for me overall now, and kind of the yield I got from my initial investment was just over 7% on my purchase price. And if it gets back to the kind of 30 pence dividends that it was in 2018, that's just up at over 8%. So again, for me, in my kind of like park the bus, I want to get 10%. If the yield alone grows to something close to 10%, and then I get this share price appreciation as well, that's kind of a nice job for me, quite straightforward. So that's why I've liked Aviva. I mean, the share price now, I still think's quite reasonably priced. I think the sector as a whole is quite reasonably priced. Insurance is quite difficult to understand how those businesses operate, but kind of I think the key ratios that I read on in terms of liquidity coverage, that they seem to be prudently managed. And I'm kind of I think Amanda Blank appears to be doing a good job, and presents the strategy very well, very easy to understand. And I don't think you can ask for a lot more from management than that, really.
You've got quite a few small caps in the portfolio, which is not something that I've ever really looked at, and we've certainly never covered on the show. I've just picked a couple of them at random. So Supreme and Mind Gym. Could you talk a bit about those, and also how you actually find the small caps in the first place?
Yeah, I mean, this is I suppose this is the again, this is kind of like I'm hoping they'll do my the job that likes of Frank Lampard and Eden Hazard did, in that these can kind of give me that bit of turbocharged returns. But one of them I found was Mind Gym. I've actually been there. So Mind Gym do corporate training courses and coaching, but it's like behavioral based. So it's all about it's almost like behavioral psychology and how that affects your performance in work. I follow sport a lot, and I've seen how that has really taken over in sport. And I just think the corporate world tends to pick up on these things. So it was a bit of a scuttlebutt type of play that I attended the course, and I thought it was excellent. Like, normally you sit through a training course and it's someone droning on for a few hours and it's pretty dull. Whereas Mind Gym, they actually get you doing things and working on things, and you come out actually thinking that was really useful. And I just noticed it was in my stock screamer. So my kind of Quarp stock screener that I've set up on SharePad. It was in there at the bottom because it was got a pretty small market cap, and I just started looking at it at that point. So I thought, well, corporate training, it's a competitive space, but there's a very large total addressable market there. And I thought with the kind of like focus on corporate ESG and woke culture, this kind of behavioral psychology, behavioral based stuff is going to be more of a focus area. They've worked with some big blue chip clients in America and Europe. So they work with the likes of Coca-Cola, ING, I think Schneider Electric, a few others. And I think they've got a high percentage of recurring revenue. So I think in the last report they were saying kind of over 90% of revenue was kind of repeat business. And then it ticked a lot of my quality metrics. And I looked at the owners. So the owners, it's a kind of founder-led business, which again, I like. They own over 60% of the business. So again, I thought, they stand a lot more to lose than I do if this doesn't perform. And there's a guy called Dr. Sebastian Bailey, who's a qualified psychology, and he's written several papers and books and seems to be well respected in that field. And then there's a guy called Octavius Black, and him and his partner own large amounts. And when the share price corrected during the COVID crash, I think the two founders bought nearly £1 million worth of shares between them. So it's cash generative. I think that they didn't turn a profit this year, but Octavius Black, who's one of the founders and the chief exec, he was quite upfront last year, and he said that we need to accelerate our digital transformation. I'm going to plow all that profit back into a digital transformation. And if I haven't done that in 12 months time, you can call me out on it. And that's what he's done. And I just think it builds a picture of management. Like I'm quite happy when, okay, it might not do the share price any favors in the short term, but when you've got management who will just say, look, this is what we're going to do and this is why we're doing it, and we think it's better for the business, and that backed up with the fact that they own nearly 2/3 of the business, I think gives me confidence, as well as being quite thinking it's got a good product and already embedded with some good clients. So that's mine, Jim. Again, if anyone ever gets a chance to go on one of the training courses, I'd have a look at it. And then I think one of the other ones like to talk about was Supreme. And this one was a bit different. So it was mentioned by, have you ever listened to the Capital Employed podcast?
No, I haven't.
I think the guy who runs it, he does they're quite good. They're 15, 20 minutes, and he'll pull in normally someone kind of professional or fairly high profile. But there was a guy called David Collins on it he's a fund manager, a kind of small, almost boutique fund. And he mentioned a couple of businesses, but he mentioned Naked Wines, which I'd heard of, and Supreme, which I hadn't. On Capital Employed, the presenter always asks for kind of two stock suggestions, and 9 times out of 10 I'll look at them and go, that's not for me. But I looked at Supreme, and again, it's founder led. I think Sandeep Chander, who's the kind of runs the business, I think he kind of came out of a market stall that he went to work on at 16 with his dad, is what I understand, and he now holds over half of this company, and it ticked a lot of my quality criteria. It's got cash on the books, it even pays a small dividend, and he's got this kind of historical business of lighting and batteries distribution. He's got a vaping product that sells in a lot of the discount retailers. I mean, I'm not a vapor, but if you have a look at the TrustNet reviews, it does very well. And he's also started, he's recently acquired some like fitness and wellness brands, particularly nutrition, and he's kind of aiming to be the kind of discount Holland and Barrett. And again, they all get very good reviews. So he's got a product called Sea Lions, which I think is online only, kind of multivitamins and supplements, and you can get like a year's worth for like £6, and he's got a brand called Millions, which is a bit more upmarket, and I saw an advert for it on the TV, I think just the other day, with Davina McCall kind of on it. So again, it's like for a small business, it's there. And he was talking about essentially how over the years he's developed a really strong relationship with lots of different retailers, so that makes the business a bit less risky, in that they're not held to kind of be dependent on one client. And he went on a podcast called Inside the Four Walls, which is supposed to be about a podcast about sports nutrition, but he ends up talking about this business, and it was just like it was fascinating. Like you get a clear sense that he knows what he wants to do, and you kind of how to do it and how to execute. And he was talking about essentially how some of the brands he bought that failed because they didn't have the scale, the kind of manufacturing scale and the scale of customers to sell to, and how Supreme have got that. And he talked about, just very interesting things about one of his brands who's saying one of the discount retailers, they kind of promote it when you walk into their store. They've got it all kind of advertised and promoted, and that kind of does some of his promotion for him. And he talked about when he kind of buys businesses, he identifies the few people that really add value in there and kind of just concentrates on letting them get on with running that business. So it was, like I say, it ticked a lot of those boxes. And again, I went on SharePad, looked at the, if it had any institutional ownership, and you've got kind of Slater, who's the son of the guy who did the Zulu Principle books. He owns an 85%. I think Canaccord have got just over 7%, and BlackRock just under 5%. So I thought, okay, it's a small business. That the vaping business is very good. I wouldn't be surprised if that was a target for one of the tobacco companies eventually. And the kind of fitness and wellness supplements seems to be growing really quickly. And then they've got the kind of historical batteries and lighting businesses that are just kind of steady ticking along, but give you that kind of solid base of revenue and profit.
I might have a look at that, actually. That's quite interesting.
He's a really interesting character, the chief exec. I was looking through the message boards, just to see if you can find out about him and what he's like. And he's, I think over 10 years ago, and this was before the business was listed, he bought a business from out of receivership. And apparently the receiver was persuaded him to buy it and said, this business will make you £1 million within 10 years. And I think at the time he bet him like a Range Rover, I don't know, some luxury car that it would. And it did. And he actually, through social media, tracked down this guy who's recommended the business when he was putting it into receivership and given this luxury car 10 years later. So it either shows his character, or he's knows how to get some good, relatively cheap PR, or a bit of both. But again, I think it's that kind of thing. Just thinks, well, he's someone with a bit of integrity.
What do you like about Biogen? This isn't a stock I've ever looked at before, so I don't know anything about it. I
hate Biogen. I absolutely hate Biogen. It was, it was again one of my first investments. So when I was talking about the acquirers multiple, Tobias Carlyle's got a stock screener that you can use the S&P 500 one for free, and Biogen was rated quite high at the top of it. And I looked at it, and they've got this. Have you heard of the Alzheimer's drug that they're developing, or they've developed Biogen?
I've never looked at it.
It got a lot of it made a lot of the news in America. So they developed this drug to kind of help prevent the onset of Alzheimer's, which clearly is a bit of a game changer, but there's been question marks about its effectiveness. And when I bought this, I kind of bought it because it was cheap, and it was I think it had failed some of its trials, but they had other similar drugs in the pipeline. So I thought, well, I'll take a small position and see what happens. And against all odds, the FDA approved it, and the share price absolutely rocketed. And what I should have done is just sold it then, but I didn't, because then you started hearing about how much they're going to sell this drug for and how much of a game changer it is, and you just start counting future profits before they materialized. And it just, I think, because there's question marks about the effectiveness and because of the amount they were charging for it, it's not really taken off, and it's just dropped. So it's only a small part of my portfolio, and it's almost like me a lottery ticket on if they're kind of hit on that Alzheimer's treatment. But it's just one of those where the stock price has kind of been so volatile. Every time it gets a bit of positive or negative news about that Alzheimer's treatment, it swings from one extreme to the other, and it just irritates me now, because I just look at it and think I should have got out on the best news after the FDA approval, but I didn't, and it's a small position. So I thought, what, I'll leave it. I know again it comes back to psychology, but I've got in my head that the second I sell it, the second that drug will take off, or the next generation of it will take off, and everyone who held Biogen will be kind of made had a 10 bagger on the hands or something. But in all reality, it'll probably do nothing.
Let me know if you do sell it, and I'll go all in at that point.
Yes, we'll do.
Right, so that's the end of the questions. So if there's anything else you want to talk about, obviously now's the time. But otherwise, thank you very much for coming on the show. And where can people find out more about you?
No, it's been great to come on the show. I would say again, not just because you've interviewed me, but I do think it's good that you and John do this, because there's so few podcasts out there, I think, that look at UK companies on a regular basis, and it's definitely given me a few ideas. So yeah, keep up the good work on that. But in terms of where people can find me, I am unimaginatively at Paul Ahdal on Twitter. Surname's Ahdal. You can also have a look at my blog, which is mrmisanthropeblog.wordpress.com. I do write up on my investments and my portfolio performance on there. It's a bit sporadic. Sometimes I'll be prolific, sometimes not. I'm doing a bit of an investment course at the minute, like on how to analyze stocks. So that's taken up a bit of my time, but I'll probably post more on that in the future. So yeah, that's where people can find me, and keep an eye on whether I will be able to say FY to my employers in just under 12 years' time.
Do you want to spell out the blog name as well?
Yes, it is mrmisanthropeblog.wordpress.com. I was hoping to get a matching Twitter handle, and it had already been taken, and every variation of it had been taken. So
well, at least your name was still there.
Yeah, very true, very true.
Right, well, thank you very much for coming on the show, and thank you everyone for listening. We'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.